Welcome to the U.S. Financial News Channel, friends. Here are some top financial news for the day. Fitch Ratings warned that the U.S. banking industry has inched closer to another turbulence. The risk of rating downgrades on dozens of U.S. banks that could even include JPMorgan Chase, a report from CNBC said Tuesday. In June, the rating agency lowered the score of the U.S. banking industry's operating environment to AA negative from AA, citing pressure on the country's credit rating, gaps in the regulatory framework, and uncertainty about the future trajectory of interest rate hikes. Earlier this month, Moody's had downgraded 10 mid-sized U.S. banks and warned it may cut the ratings of several others. The another interesting news is about the renowned investor Michael Burry, famed for his accurate prediction of the 2008 housing market collapse, has made a substantial wager of more than $1.6 billion on a potential Wall Street downturn. According to recently released Security Exchange Commission filings, Burry's bearish bets target the S&P 500 and Nasdaq 100 indices, with his fund, Scion Asset Management, investing $866 million in put options against an S&P 500 tracking fund, and $739 million in put options against a Nasdaq 100 tracking fund. Burry's strategic move reflects a significant allocation, as more than 90% of his portfolio is committed to these market decline positions. However, Burry's stance on market trends has shown some fluctuation throughout the year. In January, he cryptically tweeted "sell" to his 1.4 million followers, only to backtrack by the end of March with the admission that he had been wrong in his assessment, stating, "I was wrong to say sell." While Burry's bearish outlook contrasts with the S&P 500 and Nasdaq 100 performance this year, which have registered remarkable gains of nearly 16% and 38% respectively, the investor's previous achievements lend credence to his predictions. During the mid-2000s, Burry gained prominence by placing a strategic bet against the housing market, yielding substantial profits from the subprime lending crisis and the subsequent collapse of major financial institutions in 2008. As markets continue to evolve, Michael Burry's latest bearish bets remain closely watched, inviting speculation and anticipation among financial experts and enthusiasts alike. Finally, Goldman Sachs is reportedly gearing up to cut a substantial portion of its workforce, with around 3,200 job positions set to be eliminated shortly. The move is in response to challenges in the investment banking sector and a strategic downsizing of the consumer banking arm. These cuts account for approximately 6.5% of the bank's total workforce, which stands at around 49,000 employees. This reduction falls below earlier discussions of a potential 3,900 job losses, indicating a potential smaller outcome. Notably, the scale of these job cuts is significant, surpassing many of the bank's industry peers. The decision reflects a blend of factors, including the rapid expansion of Goldman's employee base over the past years. As Goldman Sachs restructures its workforce, it illustrates the bank's adaptation to an evolving financial landscape. Thank you for your time, and please don't forget to subscribe our new channel.